Welcome to the Deep Dives, where we sift through the sources so you don't have to. Today, we're diving into something pretty fascinating. It's like a paradox, really. How can some investments in, the same company just soar, like unbelievably high, while others suddenly need a total rethink, a whole new strategy? What does it take to manage those completely different situations inside one global business? That's what we're trying to figure out today.
It is a complex picture, definitely intriguing. And our focus today is the recent Q2 2025 earnings call from Las Vegas Sands, or LVS, as most people know them. And this deep dive, it's not just about looking at spreadsheets, right? It's about understanding the intricate dance of this huge resort operator across two really dynamic Asian markets, Singapore and Macau.
Exactly. Our mission here is to unpack the key stuff from their financials, sure, but also from what their leadership actually said, those candid comments. We want you to quickly get a handle on what's really driving their results, the challenges they're facing, and maybe where they see these giant multi-billion-dollar properties going next. Get ready for some pretty surprising facts and maybe some strategic curveballs, too. We absolutely have to kick things off with Singapore Marina Bay Sands MBS because they had what the CEO Robert Goldstein flat out called a historic quarter. He even said something like, it's unprecedented for a single building to perform like this. I mean, we're talking an adjusted property EBITDA of $768 million, which, for you listening, that's a key number. It shows the raw operational profit, how much cash the place is generating before things like interest and taxes. It's a pure look at its earning power.
That number, $768 million,
Yeah.
it's huge. And look, the mass gaming and slot win figures, $843 million, just to give you some context. That's up 97% compared to 2019 pre-pandemic levels, and 40% higher than just last year. Goldstein even said their forecast, their target, of $2.5 billion in annual EBITDA. And well, he said it may just happen this year, which is, frankly, an extraordinary thing to say about one single building. It really shows the incredible efficiency they're getting there. It sets a new benchmark, maybe redefines how people value these kinds of places.
Okay, those MBS numbers are, yeah, astounding. But digging a bit deeper, beyond just, spending money on upgrades,
Yeah.
what's the secret sauce here? What really allowed MBS to hit it what the CEO called unprecedented? Is it just the fancy rooms and service, or is there something more maybe about Singapore itself?
Yeah. Well, it's definitely a few things working together. The investment in the actual product, that's real. Like the Tower 3 hotel rooms they just finished renovating, that's over 1,800 rooms, nearly 800 suites, plus the better service. They literally said it's a different building than it was 5 years ago. That's a big part of it. But yeah, you're right. Connect that to the bigger picture. Singapore itself is clearly a very desirable destination. It pulls in high-value tourism and, critically, new money, new customers from these growing economies in Southeast Asia, places with lots of new wealth creation. And they note the propensity to gamble in that part of the world, it's pretty high. The company actually thinks they're still in the initial stages of realizing the benefits of their investments there, which, wow, that suggests even more potential.
But even with performance like that at MBS, there's always that little variable, isn't there? The hold rate, how much the house wins. They mentioned how swings in that rate can really affect the quarterly EBITDA. Remind us how that works.
Right, the hold percentage is basically the casino's expected win from the money wagered. It can fluctuate based on luck, really, in the short term. Patrick Dumont, the president and COO, he pointed out that if the hold hadn't been higher than expected this quarter, MBS's EBITDA would have been about $107 million lower.
Ah, okay, so a decent chunk.
Yeah, it's significant.
Yeah.
But importantly, they also stressed the underlying volumes, how much people were actually betting, looked really strong. So they're not changing their long-term expected hold percentage, which is 3.7%, at least not for now. The underlying business looks healthy.
Got it. And that underlying strength fuels their future plans, right? This MBS expansion project, IR2.
Exactly. They've already broken ground. This isn't just a renovation, it's huge. An $8.0 billion investment. It's going to have a whole new hotel tower, a rooftop attraction, more premium gaming areas, convention space, and get this, a 15,000-seat live entertainment arena.
And the really important bit here, practically speaking, is that it's being built on an adjacent site. So the construction shouldn't really disrupt the current MBS operations day to day. That's quite different from renovations that happen inside an existing building.
Very different, yeah. A smart move. Construction kicked off May 26, 2025. They're aiming to open in January 2031. Though there's a bit of a deadline nuance with government approval needed for July 8, 2029. But, the target is early 2031. And they've already spent about $2.4 billion on this project. That includes a hefty $848 million payment just for the land premium, securing an extra 2,000 square meters of gaming space.
The serious money already committed shows their confidence in Singapore long term.
Absolutely. Okay, so now let's pivot. From Singapore's soaring success, let's talk Macau, where, as you hinted, the story's quite different this quarter. The company was very open about it. They said they underperformed. Adjusted property EBITDA there was $566 million. Good, but not Singapore level, and apparently below their own expectations.
And they were pretty blunt about why, weren't they? Robert Goldstein saying, "We were not aggressive enough as it relates to customer reinvestment. We believed our billings would be enough. We were wrong." You don't often hear a CEO just say, "We were wrong," quite like that on an earnings call.
You really don't. It's quite something. It shows, I think, how competitive Macau is and maybe how they misread the post-pandemic recovery dynamics there initially. But what's key is their reaction. They made an immediate change in approach, like right in the middle of the quarter, rolled out a more aggressive customer reinvestment program, basically giving more back to players to attract and keep them.
And are they seeing results from that change yet?
They say they are. Encouraging initial results in May and June. The clear goal now is to redeem Macau, get it back on track. They've set a short-term target, a run rate of $2.7 billion in EBITDA for Macau, which is up significantly from the sort of $2.2 to $2.3 billion level they were at. And they've broken it down by property. They want Londoner and Venetian combined to hit $2 billion. Parisian and Four Seasons aiming for $300 million each. Sands Macau, another $100 million. Very specific goals.
Okay, so they're putting targets on each property. You mentioned the Londoner. That seems to be doing well already, heading towards $1 billion a year in EBITDA.
Yeah, Londoner seems to be a real positive. It's 2,450 Londoner Grande rooms and suites. They were all fully up and running from late April. That helped push its margin to nearly 32%. But Grant Chum, who runs Sands China, he was careful to point out the increased reinvestment wasn't just for Londoner, it went across the board. But he did kind of imply that the smaller places, like Parisian and the original Sands Macau, might need even more adjustment to their reinvestment levels. So while Londoner is a bright spot, yeah, fixing the overall Macau performance is still very much a work in progress across all their assets there.
Makes sense. What about the Macau market overall? Are there positive signs? They mentioned GGR, gross gaming revenue accelerated in Q2.
Yes, the overall market tide seems to be rising, which definitely helps. Macau's GGR picked up pace in Q2. And mainland China visitation, a key driver, was up over 19% in the first half of 2025. That's a pretty healthy increase.
So what's behind that? Is it just high rollers coming back, or?
Yeah. It seems to be broader than that. The sources point to strong VIP segment growth. Yeah, up 26% compared to last year. But also solid high single-digit growth in the mass market, the non-rolling tables, and the slot machines. They attribute this to better customer density, just more people on the floor, and also the calendar of events drawing people in. LVS management seem to think that while events help, shift when people visit, there's an underlying strength building. It's starting to look a lot like pre-pandemic Macau, was the phrase used.
Interesting. That suggests a more fundamental recovery, maybe.
That seems to be their read on it.
And it's interesting how they're actively trying new things in Macau now, borrowing ideas from Singapore. You mentioned side bets, progressive jackpots, smart tables.
Yeah, exactly. It's that cross-pollination idea, taking things that work well in MBS and trying them in Macau, like popular side bets or progressive jackpots on Baccarat. That adds a bit more excitement, potentially increases play. And smart tables, that's about using tech to track play better, manage games more efficiently, maybe optimize that whole percentage we talked about. It's about leveraging insights from one market to boost another.
Okay, and it wasn't just gaming, right? Retail in Macau saw some recovery, too.
That's right. Their big shopping mall portfolio there saw a good recovery. Tenant sales were up 10% across the board in Q2. That was driven by increases in base rent, the fixed amount tenants pay, but also overage rent. That's the percentage they get when a store's sales go above a certain point. Luxury sales were apparently a bit weaker overall, but they said even that's improving, helped by new flagship stores opening up.
So lots of moving parts operationally, but there's also this legal issue hanging over them in Macau, isn't there? This AAEC lawsuit.
Yes, that's still ongoing. It's important context. Even while they're focused on strategy and operations, this legal battle continues. It's with Asian American Entertainment Corporation Limited, AAEC. The original claim, years ago, was for $371 million. But later, that was increased massively to almost $12 billion, $11.93 billion, claiming lost profits related to the original Macau gaming concessions.
$12 billion, that's huge.
Yeah.
What's the latest status?
Well, the procedural news has actually been pretty good for LVS recently. The Macau First Instance Court ruled in their favor against AAEC. The court even found that AAEC was litigating in bad faith. Subsequent appeals by AAEC have also been dismissed. However, despite these favorable rulings, management still states in their filings that they are unable to determine the probability of the outcome or the range of reasonably possible loss. They fully intend to defend this matter vigorously, but that legal uncertainty, even if seemingly diminished, it's still kind of there, a background factor for investors.
Right. A multi-billion-dollar question mark, even if things are trending their way in court. Okay, so pulling back again, the bigger picture. What does all this, the Singapore success, the Macau recalibration, the lawsuit mean for LVS's overall financial health and where they go next?
Well, fundamentally, their financial position looks very strong. That Singapore performance generates enormous cash flow, and that strength supports their capital return strategy. Just in Q2, they bought back $800 million of their own stock. Plus, they paid their regular quarterly dividend of 25 cents per share, significant returns to shareholders.
And they also bought more shares in their Macau subsidiary, Sands China.
They did. Picked up another $179 million worth of Sands China Ltd, or SCL, stock. SCL is the main entity that holds their Macau assets. That purchase bumps LVS's ownership stake up to 73.4%. They called this move meaningfully accretive, which basically means they expect it to boost their overall earnings per share going forward.
So using their financial muscle and this strength, this cash flow, it's not just for dividends and buybacks, right? It's funding those big projects we talked about.
Exactly. It underpins the huge capital spending programs like the $8 billion IR2 in Singapore and ongoing work in Macau. And it also gives them the firepower to look for growth opportunities in new markets, which makes their decision on New York interesting. They confirmed that they've stopped pursuing a casino license there at the Nassau Coliseum site on Long Island.
Why pull back from a potentially massive market like New York?
Their reasoning was about return on investment. They apparently had concerns that the potential returns in New York might be lower than they initially hoped. Particularly, they mentioned the possible legalization of online gaming, iGaming in New York, as a factor that could impact the profitability of a huge physical resort there. It shows they're being disciplined about where they spend their billions. They want the best bang for their buck.
So if not New York right now, where are they looking?
Thailand seems to be top of the list for potential new markets in Asia. They explicitly called it the greatest opportunity in Asia for the integrated resort industry. Of course, that's a long-term view. It all depends on if and how Thailand develops its own laws and regulations for integrated resorts. But it's clearly on their radar as the next big prize.
Why Thailand specifically? What makes it stand out?
Well, from their perspective, you look at Thailand, it already has massive tourism appeal, right? A strong existing tourism base, plus a pretty robust economy and likely a large local and regional population that would be receptive. They probably see potential for a development on a scale similar to Singapore, perhaps.
It has been a tale of two cities, hasn't it? You've got the, well, almost unbelievable performance of Marina Bay Sands in Singapore, setting new records for a single property, and then contrasted with that, the very deliberate strategic repositioning happening in Macau, trying to regain ground, deliver better results.
Absolutely. This deep dive, I think, really shows you how a huge global company like LVS has to adapt and innovate constantly. They're leveraging their massive success in one area, Singapore, while actively working to fix things and recalibrate where needed in Macau. It just underscores the sheer scale of this business, the integrated resort industry, and the enormous amounts of capital involved in shaping these huge entertainment and tourism destinations.
So here's a final thought for you to consider. As Las Vegas Sands is pouring these billions into expanding Singapore even further, while also intensely re-engineering their whole approach in Macau, how might these two very different growth paths, these trajectories, how might they converge or maybe even diverge more in the coming years? Could they fundamentally reshape the global tourism and entertainment landscape? And what new lessons might they learn from each market, lessons that could surprise all of us down the road?